It is time for Ask Annex. Same rules as always. If you've got a question for us, we'd love to hear it. AnnexWealth.com. Look for the Ask tab. If we can help, you click that Get Started button. In the studio, Matt Morzy, Investment Team Manager and a CFP. Welcome.
Hi, Danny.
And Sarah Kyle, Wealth Manager. Welcome to you.
Hi, Danny.
Got a bunch today. First one is from James. If my company contributes a match to my 401k, and if I leave in a year or two, I know the matching's void. Well, what happens to the gains from my investments? I'm weighing the pros and cons of opening one through my company or on my own.
Well, James, employer plans will vary. Their vesting rules will vary from plan to plan. Typically, when they refer to vesting, it involves the employer's contribution and any gains associated with them. And you can always refer to your 401k summary plan description, and that should lay out the employer side of the vesting situation.
Yeah, I think when you look at that too, is that if you are there a year or two, and frankly, who knows in a year or two if you're even going to want to leave. So we don't know those things for sure. But when you look at that, if you do get vesting and you have 20% or 40% of that match that you do get to keep, that's still free money that you don't get in any other way. So if you invest on your own, no one's giving you that free money, even if it's less than what you could have had.
All I heard was free money, and who's not for that?
Can't beat that.
Next from Kyle, what are the general opinions regarding taking a lump sum of money versus DCA into an index fund? Say, for example, somebody receives a $5,000 bonus and wants to invest in an index fund. What are the pros, cons of buying $5,000, and then he names a fund, in one shot versus spreading it out into 12 individual lots throughout the year?
To me, it comes to what is your goal with this money? When are you going to need it? What are you trying to protect yourself from? If this is something that you're going to access in 15, 20 years, spreading it out over 1 year is really not going to make very much of a difference. But it's something that you think you're going to need soon, then that might make a lot of sense. Ultimately, when people are dollar cost averaging into something, they're trying to protect themselves from timing risk of putting that investment in and having the market immediately go down afterwards. So if that's something you're really concerned about, then yes, I would start to spread it out a little bit. But I would also kind of think of what's my time horizon on this, and looking backwards, how much will that matter?
Yeah, and that's a great point. And just also, where is the market? Are we trading at the all-time highs? Have we pulled back 30% like we have this year? You got to take that into consideration too.
Next up on Ask Annex, it's anonymous. My friend's dad has about $200,000 to invest, looking for the highest yield with little to no risk and something that can be liquidated easily in case of emergency. His bank is pushing an annuity. He doesn't know anything about them. Looking where to start.
So annuities right away are not very liquid. There's a lot of rules that go into them. There's a lot of fees and penalties depending on when you get out and when you can actually even access that money in the first place. What I would start to look at, and we want to caveat this with a lot of those disclaimers in terms of where you're coming from and what your risk level is and all those types of things. But obviously cash is extremely liquid. You can go to the bank at any point and get that. Money markets is kind of a step up from that, from risk and timing. You can still get to that every day and they start to pay higher interest rates. A lot of the custodians that we work with, the interest rate that they're paying has gone up significantly this year, and it's a really attractive place to put short-term money in. And you start to broad out from that to maybe treasury bills, stuff like that, that's going to pay a little bit more and is extremely liquid as well too. But I would start to look at things like that. But again, that also relates to what's your full financial picture, where does this fit into that, and some of the things you got to think about there.
With the Fed raising rates right now, we actually have an alternative to investments. We're actually getting some yield on our cash. And the bonds are actually paying good interest now. So it's definitely something to look at. And just be careful, too, with those annuities. They say that, okay, maybe they're going to pay you 4%, but they might charge you 3% in fees to get that 4%. So just do your due diligence. Just make sure you're informed.
Next is from Phil. During earnings calls, what are you listening for besides forward guidance? Are follow-up questions from analysts helpful? Also, are earning calls the only time for truly valuable information?
Yeah, that's a great question. So there's a lot that happens within earning calls. And, certainly you get the management that's expressing how they feel the company is going and some of the things that they're looking out for. But also remember that they're a little bit biased. They work for that company. They have a motivation behind those calls. What we also really like to listen to, as you notated in the question, is the analyst questions. Often those analysts know those companies extremely well, and they're able to pull information out from those executives that they don't necessarily want to give out. But in terms of answering that question, sometimes that has to come out there, where maybe a little bit more of that public information starts to come out there and starts to fill some of that story. We also like to look at how do those executives answer questions that might give us some guidance on what the overall economy is doing, what their sector or industry is doing as well too. So it might not be company specific, but as we start to do our research, we hear questions that go through there that gives us a little bit more color.
How many earnings calls would you say the investment team listens to in the course of a year?
It'd be hard to quantify that for sure. There's a lot of individual companies that we listen to, obviously each quarter, and then we start to pile that up because we want to hear how they answer from quarter to quarter as well too. It's a high number for sure. I don't know how to quantify it though.
Every once in a while you'll see on the news where it actually kind of gets contentious. Do you hear that as well?
Oh, for sure. Those analysts, they're trying to pull information out of the executives. And if they're not getting answers that they like or that they think they should be giving, it certainly will. Or when executives are coming out and putting out new information or new things that are happening, sometimes it does get a little bit too much.
I'll have to listen. That is Ask Annex. Got a question for us? You head to our website, look for the Ask tab. If we can help you, hit that Get Started button.